Coming up, we check in on boardroom diversity. The ASX ignores the war for now, and more on that AI IPO hype. All of that and more next. Hi everyone, welcome to the SBS on the Money podcast for this Wednesday, the 10th of June 2026, a day where the Australian share market rose, the S&P ASX 200 up 0.6%. We'll have the details soon with Matthew Sherwood from Perpetual, including what he is telling his clients. If you're new to the podcast, welcome. We go into more detail of the top consumer finance and market news stories covered during On the Money on SBS World News. But first, new research shows the boardrooms of Australia's biggest listed companies are less male-dominated than they've ever been. There's just 4 all-male boards left across the ASX 300, down from 46 when the Board Diversity Index began 12 years ago. But while gender representation is improving, progress has stalled in other areas. Cultural diversity is actually declining, with only 6.5% of directors from non-Anglo-Celtic backgrounds. Only a handful of directors publicly identify as LGBTIQ+, 4 are Indigenous, and none have disclosed that they live with a disability. To find out more, Stephanie Youssef spoke with Watermark Search managing partner David Evans.
David, the ASX 300 is on track to have no all-male boards. Is this a genuine diversity success story, or does it mask deeper representation problems?
Look, I think the progress shown really shows us what can be done. When we started this research over 12 years ago, there were 46 or 15% of boards were all male. As of this year, it's 4 boards, or 1.4%. This is a significant change. There's been much research into what has created the change. And one of the greatest contributors has been the AICD Chairs Mentoring Program, which we're delighted to be a part of. However, I sense there's been a singular focus on this form of diversity, and boards are overlooking the benefits of diversity in all its forms. In this climate of geopolitical change and productivity challenges in the Australian economy, boards should be looking at every lever they have to tackle these challenges. It's my fear that we are looking at this challenge through a very narrow lens. Outside of gender diversity, there's been very little progress, and in some cases, we've actually gone backwards.
While gender diversity is improving, cultural diversity has gone backwards. Why are boardrooms still struggling to reflect the Australian communities and customers that they serve?
Look, at Watermark Search, we appoint many board directors. We work with boards of all size, scale, and complexity. And whilst some boards see the value diversity can bring, others are taking the perceived flight to safety of appointing someone who has a similar background to them, rather than seeing the potential of what a different perspective could bring to the boardroom table. Having a board who has very similar lived experience is a risk issue. How are boards expected to solve the challenges we face through a very narrow lens? Are we truly able to look at all the options and considerations if we all have the same lived experience?
There are even fewer directors who identify as LGBTIQ+ or First Nations, and none who disclose a disability. What practical steps can companies take to broaden the range of voices around the boardroom table?
Yeah, those stats are a concern. And, with our partners in the Deloitte and the AICD, we've come up with 7 steps to support boards and what they can do to actually shift the needle on this. And they're listed in detail in our report. But to give you a summary, make this a strategy. Don't make it a nice to have or we'll get to that when we have time. Make it a strategy now. Really revisit the skills matrix. I look at a lot of these and don't necessarily look at what it is today. Look at it and where you'd like it to be. And how do we work towards that over a couple of years or a reasonable time frame in order to get there? I think the third one is around, embedding diversity and inclusion at all stages of the organisation. How do we get more access to the board? How do we support diverse leaders? All of the steps through the organisation, what else can we do? The fourth one is around reviewing tenure practices. How do we ensure we have fresh perspectives at leadership and a board level and they're reviewed frequently? And then fifth one, support the next generation of leaders, give them greater exposure to the board. There's lots of ways that we can get aspiring board directors to have some exposure through committees, presenting on boards, subcommittees. There's lots of things that we can do. Be open to the challenge. Create an environment where different viewpoints are encouraged. And then a final one is just set specific goals. Measure yourself against them. Hold yourself accountable and see what we can do over a reasonable period of time.
Critics often argue that board appointments should be based purely on merit, not diversity targets. How do you respond to those concerns?
We wholeheartedly agree with the view the board should be appointed on merit and then measured on their performance. They are not mutually exclusive. From our experience, there are many candidates who have the merit, but who have a different lived experience and are often overlooked. It's about merit and bringing the different views to the table, encouraging different perspectives to look at challenges in this very challenging economic climate we find ourselves in.
The report argues that diversity leads to better decision-making. In today's climate of economic uncertainty and rapid tech changes, can companies afford not to have diverse perspectives at the table?
Look, our view on this is that looking at these challenges through the way we've always looked at problems really creates a risk issue. One of the key roles of the board is to manage risk and to only look at challenges the way we've always looked at them or through a very similar lens creates a risk for the board, the organisation, the shareholders, and everyone who works for that organisation. This is not a social imperative. This is around a business performance and a risk initiative. And if boards don't do more to action this, they're creating a greater risk for them and their board over the longer term.
That is Stephanie Youssef there speaking with David Evans from Watermark Search. Let's take a look at the Australian share market today, which rose 0.57% to 8,653. That's on the S&P ASX 200. And despite renewed hostilities in the Middle East, which set the gold price to a November low, investors continue to pile into defensive names like Coles, which rallied around 5% today. Woolies up more than 3%. Bunnings owner Wesfarmers climbed more than 4%. Tech stocks, though, fell, and with just days to go before what is expected to be the world's biggest share market float, I spoke with Matthew Sherwood. He's the head of investment strategy at Perpetual. Matt, how would you describe investor sentiment at the moment? I mean, if you look at today specifically, it would appear our share market has largely ignored the latest US strikes in Iran.
Well, sentiment feels somewhat complacent with investors looking through the earnings bubbles among the AI hyperscalers and upcoming rate increases by central banks. Now, in reference to today's performance, I would note that Australia has been the worst performing market since the Iran strikes began. So there's no need to take profits here simply because there hasn't been any. And I would contend that investors have figured out probably that global growth is resilient and is much more important than Middle East geopolitics.
In the local market, is it fair to say that we're seeing a rotation out of stocks into like the defensive parts of the market? And why is that?
Well, there's been a little bit of a rotation, that's true. I think that's probably more to do with portfolio rebalancing after 9 weeks of rebounds. But there's only a sustained allocation into defensive sectors if investors feel economies are heading into a downturn. And I think that risk is moderate in Australia, and I think it's even lower in the US. So, my suspicion is it's just portfolio rebalancing more than anything else.
What about the interest rate story more broadly? In the US, we saw some strong job numbers over the weekend. I think as a result, the market thinks there may be an interest rate rise towards the end of the year. But here, it almost seems like the story's changing. NAB yesterday said that they're expecting now the next move in interest rates here to be a cut, not until next year, but, we were talking about more interest rate rises.
Well, markets have spent most of this year pricing out Fed easing, which never really made sense to me because the US economy is incredibly strong. Unemployment's at 4%, inflation's running at 4%, money supply growth's at 5, credit growth's at 5, and growth is double trend given ultra easy financial conditions. So none of that suggests that policy is remotely restrictive, and yet the Fed at its next meeting next week is only going to have a conversation about dropping their easing bias. I think for what it's worth, the Fed's on hold this year, but there is a risk case, of course, that of one hike, which the markets have already priced in. With respect to the RBA, I still expect one more hike in August as domestic demand is strong and inflation is unsustainably high. But I tend to think that would be then the peak of the cycle.
I hate to add to all the hype that we're seeing around SpaceX, right? However, it is still likely to be the biggest share market listing in history later this weekend. AI companies like OpenAI and Anthropic are also confirming they're seeking to list at some point. Alphabet, the owner of Google, has tapped the market for billions of dollars to expand technology investment. Meta is likely to do the same. So I'd love to get your take on the space and this rush for capital, and what's the message to investors?
Well, the message is that despite huge profits and huge profit growth, these hyperscalers need even more money to fund the CapEx. Over the space of 1 year, CapEx growth for the leading AI firms has risen from 10% 12 months ago to 80% today, which means that the combined $220 billion of earnings over the past year from the US semiconductors has delivered free cash flow, which is what investors get in their bank accounts, of only about 80 billion. So for this to continue running, these firms need to fuel a bull market in earnings and continued increases in margin. And there's so much pressure here for AI to deliver. And I would think that investors' patience could soon be running short, given all the issuance that you've actually just mentioned.
We've got 3 weeks until the end of the financial year. The latest super fund data from Super Rating shows median balanced fund is up about 7.9% for the financial year to date. But given that the SpaceX IPO, I think we've seen the tech sector also fall on Friday quite dramatically. From what I heard, investors pulling money aside ready for these types of IPOs. If that's right or not, you can let me know. We've got this volatile tech sector, the ongoing uncertainties in the war. Are we headed for a volatile period leading into July the 1st?
Well, if there is an increase in market volatility in the next few weeks, I would imagine that it's more likely to be triggered not by supply issues of US equities, but rather earnings downgrades from US semiconductors or interest rate upgrades in the wake of higher than expected inflation. Now, the market is complacent on both fronts, and it would spark downgrades or a pull forward in rate hike expectation, neither of which the market is priced for. In the end, since the US-Iran situation began at the end of February, despite the price decline that we saw last Friday, the Nasdaq index is still up 13% in the space of 9 weeks. It's been a phenomenal rise that has helped super balances. The challenge is really, what upside is there left for the market this year, given that EPS expectations are running at 25%, and forward valuations are trading at 21 times, which is very richly priced.
And so just finally, with everything we've discussed, what are you telling your clients right now, and where do you see the opportunities for investors?
Well, more questions, I think, have been asked around the world of large cap earnings and whether premium valuations are justified. So I would say to them to look at their portfolios and ask if their exposures to those large cap stocks is appropriate for the earnings growth, which may be subjected to downside risks. And with bond yields continuing to move higher, ask how will I cushion my portfolio from any unforeseen events? Because there's numerous trigger points out there, so don't assume that it's smooth sailing from here.
It's Matthew Sherwood there from Perpetual, and he wraps up the podcast for this Wednesday. Give it a like, a review, and subscribe if you enjoy it. Don't forget you can watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.